Before you go home shopping, you want to make sure that you get all your ducks in a row and ready to go. The first step in that is getting your mortgage loan pre-approval. So let's take a closer look at how to find the best mortgage lender that's right for you. My name is Finney, and my passion is helping you make sense of real estate. If you need help finding a top agent near you, or if you simply want to drop me a line to say hello, my contact info is below. If you're new here, please go ahead and subscribe to this channel now and like this video. Thank you. All right, my friend, let's take a closer look at this because sometimes people really get this wrong where they're like, oh, I want to go see a house, Andrew. I want to go look at homes now. And you ask them, do you have a financial loan pre-approval yet? Have you chatted with the mortgage loan officer about your loan options? And they say no. Well, if we go out and see that home, what's going to happen if you fall in love with it and then you say to me, Andrew, I want to write an offer on this home, and I'm going to turn back around and say, well, we need a financial loan pre-approval. We got to have your loan pre-approval to submit this offer to the seller. Should have started with that, right? It's kind of common sense, and we want to get this right. So let's help you find the best mortgage lender for you. The first thing to know is that your credit score needs to be in shape. Now, when we're talking about your credit score being in shape, there's a lot of stuff out there that you hear in adverts that say, hey, if you have a low credit score, you have no credit score, we can hook you out with a mortgage. Well, you need to be very careful and read the fine print. In reality, whenever we're talking about your credit score for a home loan, you generally want to have at least a 620 or a 640 FICO score. If you get down to a 580, mortgage lenders can assist you at that rate, but it's going to be a little bit difficult. If you're below that 580 mark, it gets even more concerning because there are some ways that some people can assist you, but you got to wonder about what those trade-offs are. Best practice here is to simply work on your credit score. If you know it's not in good shape right now, go ahead and take a look at it, go over the Credit Karma, or request a free copy of your credit report to see where you are right now. Look to see if you have any collections. Look to see where you're using a lot of credit card debt. And if you don't have any credit cards, get a credit card so you can start establishing credit. Now, when you get a credit card, it's not like you want to go out there and say, hey, I'm going to go on a vacation to Tahiti and I'm going to stay at the Four Seasons and I'm just going to max this thing out. That's not the idea here. The idea here is to help you build up your credit if you have low credit or no credit. So the best way to do that is to make smart financial decisions, pay all of your bills on time, and make sure that you don't have any collections. Get those things satisfied, get those things correct so that you can get approved for a mortgage. So if your credit score is under a 620 or 640, please get to work on it right now. The second thing is to know your different mortgage lender types. There are 5 main categories. The first one are credit unions. Now with credit unions, these are generally member-owned financial institutions that often offer favorable interest rates to the shareholders. The shareholders in this case being any member of that credit union. Sometimes you can find some very generous mortgage loan rates, car rates at a credit union. So if you're a member of a credit union, go review your options with their mortgage loan officer there and see if it's going to be right for you. The second type are mortgage bankers. Mortgage bankers generally work for a specific financial institution and they package loans for consideration by the different banks' underwriters. Sometimes when you think of a mortgage banker, it's almost whenever you see those different type of adverts online, whenever you see maybe 3 or 4 different type of mortgage lenders and they're providing their different rates, their different things that they're trying to do that entice you to click on them, kind of like what a mortgage banker does where they're trying to shop and find the best rate and terms for you based upon what you're looking for in your home loan. Now your third type are correspondent lenders. Correspondent lenders are better known as like your local mortgage companies, your local loan officers, generally people that live in the same city as you're looking to purchase your new home. So if there's any hyper-specific type of loans that are available, they're going to know them because they're also your neighbor. So they're going to be paying attention to any specific city, state, or county loan programs that could be beneficial to you, and there'll be a great source of information. And you've probably heard me a lot in different videos that I've made where I share with you, get up with a local loan officer. The reason being is the very real fact that they do know so much about local loan programs and what could be beneficial to you. And also you can sit down, meet them face to face and know that you're just not a number. Local loan officers give you that opportunity to meet up right there in person and see if they're going to be right for you. The fourth type are savings and loans banks. Now savings and loan banks, also known as S&Ls, can be a little bit hard to find. They used to be the bedrock and almost like the gold standard of home loans across the United States. They're generally much more smaller financial institutions and they're much more community oriented, but they are worth seeking out if you know of a savings and loan bank in your area. area. Review your options with them and see if they're going to be best for you. The fifth type are mutual savings banks. Now, a mutual savings bank is kind of like a thrift institution, kind of like a savings and loan. A mutual savings bank will offer you more locally focused and often be very, very competitive with the rates and terms that they provide as well. So a mutual savings bank could be a good option. Now, in the case of all 5 of these, what you should do is make sure that you're reviewing all of your home loan options with those specific loan officers at each of those 5 types of financial mortgage lending institutions. Well, idea here is to make sure that if there's a loan program out there that fits you better than another one, that you know about it. Because at the end of the day, what we want you to do here is to make a well-informed decision that's going to be right for you. A lot of people take out 15-year and 30-year mortgages, so this is something that's going to be with you for quite some time going into the future. It's worth seeking out, it's worth doing some research, and it's worth making sure you're getting the best deal for you. The third thing that you want to do is get a loan pre-approval letter. It comes as a critical importance when you get ready to go in the home shopping mode. Think about this for a moment, and it'll probably set in your thing like, hey, Andrew, you know, that's pretty common sense. Because it is. You know, if you're out there and you want to go into home shopping mode, but you don't know what you're realistically dealing with in the bank, it's one thing to kind of have an ego. It's one thing to have a little bit of pride and say, hey, you know what? I know I can get a pre-approved for what I want. I know that I'm going to get approved for $600,000. I got the income for this. Yes, maybe you do. But do you also have the debt associated with some people that earn enough money to purchase a $600,000 and $700,000 home? What does your debt look like? And what does it look like on a factor of percentage when a lender is going to start taking into consideration what's called a debt to income ratio? This is all too often where some people get very aggravated because they're like, well, you know, I pay my bills on time. I do everything right. I'm renting right now and it costs me $4,000 a month. Of course I can afford that $600,000 home. It's only going to cost me $3,500 a month after I make my down payment. This may be true. At the same time, those debt to income ratios are critically important. I have seen it in practice very, very frequently where people will go out, they'll want to see a home, and that home is just too much home for them whenever they go to get their loan pre-approval. Rather than set yourself up for failure, why not set yourself up for success by reviewing the realities of your home loan and how much you can truly get approved for? Make sure that you're making the right moves at the right times so that you won't experience any type of embarrassment or hardships moving into the future. I ask you to please get real with yourself on this so that you can get this right. On a side note here, it's not like you can make an offer on a house anyways without a loan pre-approval. Any trusted real estate advisor, any real estate agent anywhere that says, hey, we can go ahead and write an offer even if you're not approved, you should be running the opposite direction from that person. And that's just the reality. Because if you don't have a financial loan pre-approval, how are you going to make good on it? How's that seller going to be confident in accepting your offer, taking their house off the market, and only about 2 to 3 weeks into the process, it blows up in everybody's face? You're out money for the home appraisal, you're out money for the home inspection, you're not going to get it back, and worst of all, you're not going to get the house. So let's be honest with each other and get this right. Real estate is a process, and when it's done correctly, it works out to your benefit, helping you all the way home into the new place that you're going to make your new memories and be extremely happy in. So let's take a closer look at some of the things that a mortgage lender is going to be looking at during the loan pre-approval process. One of the first things they're going to ask you to do is to complete an online loan pre-application. On that online loan pre-application, they're going to ask you for your social security numbers for yourself and any other co-borrowers that may be on that note. They're also going to ask you for your bank savings, checking, and investment account information to verify the assets that you have. They're also going to be looking for any type of outstanding debt obligations, including credit card, car loans, student loans, other balances, which would also include like child support, alimony, anything that you have to pay and are on the hook for. They're going to ask you for 2 years of your tax returns, W-2s, 1099s, and it will change a little bit if you're self-employed for the type of documentation they ask for, but essentially they're going to be looking at your financials for the past 2 years. They're also going to want your salary and employer information. The last thing they're going to be looking for is information on how much of a down payment you can make and where are you going to get that money from. Is it going to be money that's gifted to you from a family member? Is it going to be money that you just won at a lottery? They need to know where this money is coming from. The easiest way to think about what a true loan pre-approval is really breaks into a very simple acronym to remember, IACE. I kind of like to want to call it ICE, but it's not quite ICE. So if you want to help me with that and how to term it, that'd be great. All the same, I is for income, A is for assets, C is for credit, and E is for employment verification. If a loan officer does not do those 4 things, then rest assured that you do not have a true loan pre-approval letter. Oftentimes people say, Andrew, so how long does this process take? That really is a good question, and it really depends on your overall financial and economic situation. If you have everything ready to go and you complete that loan pre-application in its entirety from the onset, then you could potentially have a loan pre pre-approval letter in as little as 3 to 4 days, essentially the same day that you would apply. Now, that's assuming you have all your documentation that we just reviewed a moment ago ready to go and uploading it right into the application too. If everything checks out and your fiscal house is in order, then you'll get a loan pre-approval pretty quickly. Now, here's the reality of seeing this in real estate practice and also working with a great local loan officer here in Las Vegas is a lot of families that reach out, they'll go through the application process and they're going to need some work for 6 to 12 months sometimes. Sometimes they might only need work for 2 to 3 months. What are we talking about when they need work? They need an opportunity to save up a little bit more money. They need to raise their credit score up a little bit. We need to help them come up with a game plan to pay off certain credit cards so they can boost their credit score, boost their debt to income ratio so they can get approved for the amount of home that they wish to buy. So oftentimes it's just smart to get the process going, find that trusted real estate advisor that's right for you, and also find that local loan officer that's right for you so that you can get everything dialed in and ready to go. When everything is ready to go, then you can go out and home shopping and you'll be fully confident in the decisions that you're making, knowing that you can make good on any offer that you wish to write. The fourth thing that you want to do is to compare the rates of the loan officers. Now, when you compare the rates of the loan officer, I want you to know something that is oftentimes overlooked. It's much more than just the rate. You need to compare the service. You need to compare the quality of that loan officer, and you need to compare that loan officer's skill. And you might be wondering, well, Andrew, I get how I can meet with somebody or talk to them and kind of feel them out and see if they're shooting straight and being honest with me. I get that part. But when you're telling me to verify their skill, how am I going to do that? That's a great question. It's a very simple question to ask a loan officer, whether they're in any of those 5 types of financial institutions we identified earlier in our conversation, by saying, what is your closing ratio in relation to how many loan pre-approvals you issue every year? If that number is less than like 97% or 98%, kind of have a problem, right? Because unfortunately, buyers will sometimes do things in the closing process that will kill their deal and they won't be able to make good on that house. At the same time, all too often as well, lenders will sometimes say, hey, we did verify your income, assets, credit, and employment, and in reality, they did not. So we want to make sure that we get this right, and that's why I'm sharing with you, unless you're being asked for all that different documentation, you know that you haven't been truly pre-approved for your home loan. The reason I'm diving into this so deep is to keep you from getting hurt. I have seen too many people get discouraged when they realize, hey, you know, Andrew, I wrote an offer and the loan officer couldn't make good. I just want to rent now because this is just a mess. Home ownership's not for me. The world's against me. It's not that the world's against you. It's that this conversation right here, you didn't have with a trusted real estate advisor or a loan officer. We're having it now. You can get this right by planning it out. Everything in life is best done with a game plan. So let's help set you up for success. A best practice here is that as you're reviewing those different loan rates and terms being provided to you from the loan officers, is to ask each of them for a loan estimate. I'll go ahead and pop up a card right now so that you'll know how to review that loan estimate and what it means to you. And the fifth thing that you want to do is to read the fine print and ask questions. There is no such thing as a stupid question, my friend. There really isn't. If you have a question in your mind's eye, it is incumbent upon the professional to answer that question. If you have that question, please speak up. Let's air it out up front. Let's answer the questions that are on your mind to make sure that you're making a well-informed decision that's going to be right for you and yours as you get ready to purchase your new home. The more information that you have, the more powerful you'll be, because knowledge truly is power. 5 such questions that you can ask right now are: how do you communicate with your clients? Do you prefer to communicate via email, text, phone calls, or in person? And how quickly will you be responding to any messages that I send to you? Now, as a professional, just on a side note here, a professional should be understanding how you prefer to communicate, and you also should be open-minded, and they should be open-minded to communicate most effectively when you get into the closing process, however that's going to be. Sometimes that's a phone call, sometimes that's a text message, sometimes that's an email. Make sure that you guys establish the communication preferences up front. The second thing is, how long are your turnaround times on the pre-approval and appraisal and the actual closing cycle together? Now, there's a lot going on there. Now, obviously with the pre-approval, how long is it going to take to get pre-approved really is going to depend on your financial and economic health and how quickly you get that loan officer all the documentation that they need that we reviewed earlier. With an appraisal, well, that's going to happen when you get into the closing process, and you want to identify how soon that appraisal will be ordered with that loan officer when you're in contract on your new home. The third thing here that we were talking about was the closing. Well, it depends on where you live in the country. If you're in an attorney state, this process could take 45 to 60 days. If you're in a non-attorney state, it should probably take somewhere between 30 and 35 days. Not saying that this can't happen faster, because it absolutely can, and I've worked with families that have actually closed with a loan in as little as 14 days. So it really just depends on the speed speed and efficiency of the loan officer that you're working with and the overall situation. Please keep in mind, in general terms, it takes 30 to 35 days to close on your new home. And if you think about that for a moment, you're like, wow, why does it take so long? It's a great question. If there's somebody living in that house, they need a little bit of time to move out too. The third thing that you want to ask is, what lender fees will you be responsible for as part of your buyer closing costs? Now, just to give you an idea, some of the fees that could be included would be their commission, the loan origination, any points if you chose to buy down your rate are called points, your appraisal cost, your credit report, and any application fees associated with your mortgage pre-approval. The next thing that you would want to ask is, will you waive any of these fees or roll them into the mortgage? How does that work? The fifth thing is, what are the down payment requirements for the loan programs that you're qualified for? Getting clear on this up front will be massively powerful to you and will cause you to be successful when you get ready to purchase your new home. So now let's take a closer look at the 9 questions you want to ask a mortgage lender and the steps involved with getting a loan pre-approval. Looking forward to our next conversation. We'll see you in a few.